All right, welcome back. Let's talk about our call of the day. It's Bank of America today, downgraded from all right, let me start over. Downgraded to neutral from buy at Citi. The firm saying we are, quote, in a tricky period for bank stocks as net interest income tailwinds seem fully factored in, and we see downside risks to 2023 largely from a catch-on non-interest-bearing deposit outflows outweighing the benefits of fixed-rate asset repricing. Joe, you own it. Save me, please.
I own Bank of America, and I do not own J.P. Morgan. Who's America's bank? Used to be J.P. Morgan. Who's the better CEO right now? Used to be Jamie Dimon. I think it's Brian Moynihan. I think Bank of America is doing an absolutely fantastic job. I think Warren Buffett agrees with me. Warren Buffett maintaining his position in both American Express and Bank of America. It trades at 11 times earnings. It's outperforming the market year to date. And I think in 2023, any form of a modest recovery is going to benefit the wealth management unit. And I also think that trading activity, there's been a significant improvement in the intellectual capital that resides itself in that trading unit at Bank of America, and that's been fully represented in those earnings over the prior quarters.
I mean, they look at a gain, too. It's, I get that it's down 25% from its 52-week high, but it is up more than 19% in a month.
I'd rather own Bank of America right now than some of the technology names that we talked about.
Oh, okay. Weiss, Bank of America has long been yours.
Yep. And I know what you look for me to say that more important than Buffett saying he owns it is me saying I'm owning it, but I'm going to let Jason say that. Look, I've been saying all along Brian Moynihan is a phenomenal CEO. Of course, I was kidding with that. Is a phenomenal CEO. He's done the right things. I think it's more of a client-friendly bank in terms of corporate clients, in terms of wealth management clients than J.P. Morgan. They're both excellent CEOs. I don't know if you can put one above the other, but Bank of America I always found to be less expensive and undeservedly at such a discount to J.P. Morgan. I also own Goldman, and yeah, it'll be rocky a little bit with net interest income and margins there, but if the economy is going to get, and this is where it's a hedge in terms of the economy, if I'm wrong, if the economy is going to improve, the yield curve is going to uninvert, and then you'll see them able to capitalize on the spreads more so than they can now. Also, I think you'll see the first quarter or second quarter, the latest, capital markets reopen, and that's fat margin business. So as you know, Scott, I'm not just a short-term trader. I'm also a long-term investor. I own this for a while. I'm staying there.
Okay, good stuff. Jason Snipe, you own BAC as well.
Yeah, so even if you look at this this downgrade as an example, they kept the target at 40. There's still 4% upside. And, the net interest income story is obviously the story that played out very well with earnings a couple of weeks ago with Bank of America and a lot of the other financials. They're still cheap relative to the market. I am concerned about kind of the inverted yield curve and the softening or slowing of the economy. But these banks are very well capitalized, and I think they could stem the tide, going forward. So I still like Bank of America here.
So, Amy, you heard Joe say at the outset here he would take Bank of America over J.P. Morgan. You take J.P. Morgan quite literally because you own it and you don't own Bank of America. Why don't you argue the other side then?
Well, I just looked at Bank of America, and obviously I own J.P. Morgan and Goldman. These stocks seem to really be trading together. I can't argue that, this year Bank of America has outperformed J.P. Morgan. Prior years, it's been the reverse. But the financials are really trading together. If I look at all the multiples, they're all trading between 10 and 11 times. They've all had a very nice run of late. We were underweight financials for a long time. We went more market weight earlier this year. The outflows out of the financials groups are very supportive for them going forward. I think the money coming out of fintech, I just looked at a firm, going from 200-ish to 16, that sort of competitive playing field moving back towards the banks is helpful. I don't think that we're going into a particularly deep recession if we go into a recession in the next 6 months at all, which I'm still don't think is my base case. So, I think the financials are a good place to be right now.
I like the point, Joe, that Amy just made, right? She cites the firms of the world and money coming out in, maybe a more heavily scrutinized atmosphere for more speculative parts of various industries. And if money coming out of those finds the way into more traditional financials.
Brilliant. And I think Amy is not only onto that with financial institutions, I think she's onto that with the entirety of the overall market, where the safety of traditional assets, the safety of a word that I've heard Amy use and Jason use and Steven use, quality, I think that's going to be important as you look forward. But I think, yeah, without question, in the financial services industry, you're going to fall back upon, okay, I want to make sure that I am comfortable. I want to make sure that the leverage exposure, the risk assumption is where it needs to be.
All right.